Good morning, ladies and gentlemen. Welcome to Business Today Television. I'm your host, Shail Bhatnagar. I wish I had anything positive to say as far as Indian equity markets are concerned. You all know that not only India but across Asia and in large parts of the European and American futures markets, there is a deep shade of red as equities, currencies, commodities, and bonds react to this tariff war that has now escalated over the weekend. There shows no signs of abatement as far as prices are concerned, and the fall is now getting worse after a gap down. I will not waste further time but take you to Mr. Sharad Awasthi, one of the very few people who has always had his head firmly screwed on his shoulders, especially during crisis time. Sharad is the head of research for the private client group at Smith's Securities and joins us from Kolkata. Namaste Sharadji. Without further ado, let me just ask, are you shopping at this point of time in the market, or is pain going to escalate and therefore you are keeping your powder dry?
Namaskar. I think this is not the time to keep your powder dry. You should have kept it dry 6 months ago. Now is the time to go full-fledged shopping. What are we talking about? We are very nervous about 45 billion of exports hitting a 4 trillion economy, right? So, I mean, okay, you want to make a big deal out of it, sentiment-wise, globally, maybe some other countries might be hit, but we are not an export-led destination. But markets are an animal like this, everything gets interconnected. In PPP, that is purchasing power parity-wise, we are a 14 trillion economy. So out of that 45 billion, maybe 25 billion of exports do get a hit, which I seriously doubt that all of it will get a hit. But then you consider the percentage-wise impact, I think it is going to be negligible. The second issue is that how this whole thing will pan out, and what cross currency movements will happen, how the extra supply that is available in various nations will lead to US going into a recession. These are the two major things that are bothering us right now. So consider a company that grows at 1%. I think what's a recession then, that when it does not grow, it doesn't really matter much, right? It's the sheer size of US that is advantageous to us. So 1% growth here and there doesn't really matter much. So I think there is too much hype and hoopla because of the dependence on US. The second part is what happens to the oversupply that is available in these countries, which are currently exporting to the US, whether they will get dumped into countries like India or some other countries, which I seriously doubt given the current, the Indian government and how proactive they have been with respect to tariffs, etc., and arrangements. So I don't think you should be very nervous. I think certainly this is a great time to go out and shop your heart out.
Okay. With that background in mind, Sharadji, where have you opened your heart and purse strings together?
So I think amongst the large caps, something like a Reliance looks very good at these valuations. Similarly, if you want to do some bottom fishing, a Tata Motors is an excellent idea. For Reliance, we are working targets of around 1800, 1850 on SOTP. Geo listing, retail listing could be possible triggers. The green energy business ramping up could be another trigger to the valuation on the upside. But even considering current situation, I think 1800, 1850 would be the fair value for this stock. On Tata Motors, I think there is too much nervousness and that's around the JLR issue, but the various pieces are working very nicely. I don't think that US alone is a major contributor. There are other areas where JLR is working very finely. The debt issue has been taken care of. The new launch has a lot of air around it. So I think even if it trades at 11, 12 times, you could be looking at something around 1,000 rupees on Tata Motors as well. Short term, yeah, there could be some hiccups, 2 to 3 months. I think that is the time when you will have a lot of talk around these issues. Similarly, an LIC is a great idea at these valuations. A Castrol could be a very good bet at these valuations. So right now, it's very difficult to find an idea where you will not make money maybe by investing now and holding it for 1.5 years. But it might be difficult to find ideas where you will not make money holding for 12 to 18 months.
Okay, so 2 points of note, ladies and gentlemen, that these stocks are to be held for the long term. I'd just like to mention on Tata Motors that the stock has already halved from its all-time high, and generally what we have seen in previous bull corrections is that large caps fall about 50% from their all-time high, in a very, very rare instance do they fall further. Of course, there is no saying that this is the bottom on Tata Motors, but just as Sharadji has said, this is a time to make a quality long-term portfolio. Tata Motors is down exactly 50% from its all-time high of about 1175 that we saw on 31st of July. So a good time to shop on large caps, and keep a very long investment horizon as far as markets are concerned, to create value and create wealth. Sharadji, given the sharp correction that has happened on large caps themselves, and an equally, if not more deeper price fall on small caps and mid caps, would you still prefer large caps?
See, it depends on the risk appetite. If I have a low risk appetite, I think it's better to go for large caps at this point in time, because there is so much uncertainty. You don't know what gets hit where. With mid cap, small caps, you have to be very clear that you have that kind of appetite where you can, digest 20-25% kind of falls maybe in a very short span of time. Though in this correction, even some large caps have corrected like that. But I think the volatility in mid cap, small caps is a bit on the higher side. So I think if you can stomach that volatility, you have to have very clear thought that the alpha will be generated out of mid caps, small caps only. Large caps, if you get the market swing right, I think then probably you might get much better returns. But in any case, I think if you spot the mid cap, small cap right, that could be a space which could give you the alpha. So if you are looking at mid cap, small caps, I think you should be very clear that you can digest that volatility, and then you can create that alpha and keep it a bit more diversified than maybe probably the large cap portfolio.
Okay, that's a fair assessment to make as far as large and mids are concerned. Sharadji, would you feel that given this escalating tariff war, is gold still a safe haven asset? Of course, it has also started to correct 6.5% from its peak. But do you see some kind of buying coming back into gold, or after a 40% rally last year, this is also done and dusted?
Yeah, I personally am not a very bullish guy on gold. I usually only want to look at gold when you have very abnormal valuations in the equity markets or some huge geopolitical tension. Right now, I think geopolitical tension wise, we are stabilizing. Though because of these tariffs, I think there is a temporary, upheaval on the economic outlook or as such. But I don't think that these valuations, even gold, make sense more so on INR terms, because the rupee seems to be appreciating vis-a-vis the dollar. So I think that will also eat out some part of your returns. So I don't think at these valuations, at these prices, you should be looking at gold.
Okay. What else are you avoiding within the equity universe at the moment? What sectors don't look good to you despite the correction?
I think gems and jewelry may be a bit stretched still. I think they have a lot of dependence on US exports also. So that as a segment could be something, where valuations are a bit stretched. They have been so for the last 3-4 years since the hallmark thing was introduced. So I think that is one space. The likes of Trent, etc., may still be fairly too overvalued. I think even the FMCG basket may be largely fairly valued, barring the exception of maybe an ITC. So I think they have just touched their fair value levels. I think 5 to 10% correction, that should be the range where you should look at accumulating these stories. And as we are expecting urban and rural consumption to provide that boost over the next 2-3 quarters, I think then probably FMCG might look much better.
Okay. Sharadji, is it my understanding, or am I wrong, that the PSU basket is not as worst hit as is the rest of the market? Should that be the case? You've of course mentioned LIC as one of your picks about 4 or 5 minutes ago. Anything in the PSUs that catches your fancy? Maybe oil marketing companies? Indraprasth
Yeah,
Gas.
OMCs I think are a decent bet at these valuations, particularly IUC, where the dividend yield is robust. We are working with targets of 200, 210 on the stock. So I think that's a decent bet that you can look at. Even BPCL, HPCL might be very good ideas. For a change, I think even because of rapid fall in oil prices, ONGC, etc., have lost a bit of traction. But I think at these valuations, the dividend yield, what it works to around 6-7%. Similar yields for Coal India, I think, and I don't think that the long-term trajectory is anyway changed for their businesses. They will continue to be stable businesses over the next, 2-3 years at least, even beyond that. So I think these are good businesses. You have to hold on to them, and during the holding time, you have a decent dividend yield of 6-7%. Interim corrections, yeah, might take them down because of commodity-based stocks, but not much. I think even the PSU banks at these valuations look like decent bets.
Okay. Sharaji, for those who are in love with the Nifty and often look at its price to decide their investment or profit booking strategies, what level on the Nifty do you see the market going to over the next 1 or 2 months? I have often asked this to you: is the worst behind us? But I mean, at least I have been proved wrong. But what do you think? 22,000 is more pain in the offing?
I would say, maybe it corrects further, but I think at these valuations and the comparative advantage that we are sitting on vis-a-vis most other countries, I don't think we can have more corrections. The point is that there is too much hedge fund and tech-based trading that takes place. So maybe a day or two more of some correction, but nothing much beyond that. I think maximum maybe an intraday dip of 300-400 points more in the worst case scenario. I don't see that going beyond that.
Okay. So basically a 5 month low. No, this is a 7 month low. We've touched June 4th, June 5th lows in the market early trade. There was also this very sharp hope or very fond hope in the market that uh, domestic lenders will do well, which is the likes of ICICI, HDFC Bank, Kotak, NBFC plays, Shriram, Bajaj Finance. Given this sharp fall, do you see them as continued prospects? Especially, we have the MPC now starting, and there is no doubt in my mind that we'll have another rate cut.
Yeah, certainly. I think for most banks, the treasury income will also get a boost because of these rate cuts. Finally, the 10-year G6, etc., the yields have started coming down. So I think that benefit will also come over the last maybe 1.5, 2 years. They hardly got any benefit from the treasury books. So I think that plays up. The advances have been growing up. The NBFC system has been relaxed a bit. So I think that will grow again. And I think over the next, 2-3 quarters, you will see a very rapid change across the whole lending space, particularly whether it's the small finance banks, NBFCs, PSU banks, private sector banks. HDFC Kotak would remain top bets. I think valuation wise, even Axis is a decent bet at these valuations. On the public sector side, I think the likes of Canara Bank, BOB, SBI, the frontline names look very good. The smaller names like UCO Bank, Union Bank, Bank of India might look very good. An Indian bank could look very good. And the small finance banks, I think that's where a lot of advantage could come in with MSME microfinance business turning around, where the problem was more domestic in nature, nothing to do with exports, etc. So I think that could be one segment which could have a very sharp turnaround because most, small finance banks are trading at 0.7, 0.8, 0.9 times price to book. The best may be trading at say 1.1, 1.2 times. So I think there is a easy possibility that once the tide turns, these banks could trade at 2 times price to book. So the next 1.5 year, you could look at them doubling also. But the frontline names also look very attractively priced for 20-25% kind of upside from current levels.
Okay. Sharaji, how about interest rate moves? One, do you expect the RBI to act tomorrow? Sorry, on April 9th. Should that be the case, how about interest rate sensitives like consumer durables in the auto ancillary space, or maybe given the summer that we are seeing, brown goods makers? What would be your view on that asset class, given that the MPC meeting is on?
I think typically sentiment-wise, it would be a boost for them, and I think beyond that also, in the new financial year, I expect consumer durables to do much better and get a major part of the improvement, from the lower tax rates. So companies like Crompton Greaves, Orient Electric, they could do very well. The frontline names, you can do some shopping now. I think the likes of Havels, etc., they've corrected substantially now, and I think they could benefit out of the improvement that happens there. A Bajaj consumer could do very well going ahead. Particularly, I'm more bullish on the likes of Crompton Greaves because of the new markets that they're entering into. They could have very good advantage there. On the cooler side, because of this demand, I think a Symphony could be a good bet there. Also, we have seen a decent correction, and it's a long-established cooler market for them, and they have a strong brand presence there. They've come up with new products also, and some of the international operations should also do well. So I think these are the 3, 4 ideas among the consumer durable space that should do very well in the near to long term.
Would you be touching IT and pharma, which are the most exposed to this US carnage that we are seeing in terms of tariffs, even with the barge port?
I think pharma across the board I would not be touching, but I think amongst the frontline, Dr. Reddy certainly looks attractive to me. And as I told you earlier, I'm not betting too much on tariffs. I think tariffs always find a way to move around them and finally conclude the business, maybe with a bit of impact and a bit of delay of 2 to 3 months. So I'm not very worried about this whole thing. It's more of a lip service kind of thing. And beyond this, I think in IT, yeah, these valuations I would certainly want to buy across the board. I think most of the stocks are trading at attractive valuations, whether it's an Infosys, TCS, the likes of Wipro. Maybe an HCL Tech is a bit stretched, but the rest of the pack looks very good among the mid caps, small caps. I think something like a Birlasoft, Mastech, Emphasis, LTIM, Tech Mahindra all look like very good ideas at these valuations. So I certainly want to buy them.
What would you advise to all those investors who've come in the last 2 years, 2.5, 3 years, and are now seeing a very sharp erosion in their stock portfolios, mutual fund portfolios, in particular those who went in through the SIP route? Do you see this SIP inflows pausing or maybe reversing?
I think maybe it will not reverse as such, but it may go down a bit because of the nervousness and too much focus on technicals. But I think anyone who's done an SIP and who follows a long-term approach, these are the times where you should be continuing your SIP. And the best thing I'm telling you, you can do right now is stay put. Over the next 6 months, you can be rest assured no one will even talk about all this and everything will be normalized. This is a similar situation we faced during Brexit. There was so much talk that, Britain exits, this will happen, that will happen, the whole world will collapse. Nothing happened. The Brexit did not happen for 1.5 years. Even after Brexit happened, nothing happened. Nothing, literally nothing. So markets usually can gyrate, a lot of economic reports, a lot of probability. And this tariff situation is not as simple as people are making it to be. It's not easy to implement. It's not easy to gauge the impacts because we don't know. There are 1,000 permutation combinations that could play out. So unnecessarily trying to adjust, I think keep it simple. Valuations right now are very attractive. How the tariffs play out, what happens, I don't care, I don't know. So I think it's very simple. Valuations right now are attractive, and ideally it should play out very positively over the next, 1.5 years. 6 months down the line, no one is going to talk about it. Stay put into your investments, add more. Maybe it corrects more. I'm not telling this is the bottom. But at these valuations, I think the margin of safety is very much in your favor. You should go all out and buy equities.
Perfect. With that background in mind, Sharatji, thank you so much for your time. It's been an interesting conversation. And of course, in times of such panic and such sharp downturns, sensible, calm, composed, and quality advice is what that matters, which you've given in ample measure. Thank you so much for your time. And of course, we will remember Reliance Industries, Tata Motors, LIC, and Castrol India from the large cap space as potential buys at current level, and that too in a SIP format. This is what Sharatji has suggested. And maybe in the PSU space, the likes of Indian Oil Corporation, BPCL, and Coal India, given their very strong dividend yield, and of course the fact that they have established and predictable businesses. Thank you so much, Sharatji, for your time.
I've been going through a lot of our startup success stories, and when I go all over the country, we often have startup presenting to us what work they're doing. Fancy ice cream and cookies.